Hello, welcome back to the Laptop Trader channel on YouTube. Thanks for watching. This is just a quick disclaimer that this video is for information purposes only. Today's discussion is going to be a continuation of Chapter 1. So this is kind of like Chapter 1A, just some additional thoughts on, what is a stock investor, what is investing, and why should you be an investor. Again, one of my goals is to alleviate some fear around investing and hopefully inspire you to start now. I hope this helps if you are considering investing in the stock market. Again, this will be a very basic video and for newer investors. Again, start now by educating yourself on how markets work and then finding out what is right for you. Invest in yourself and then invest in the markets. So this will just be a little bit of review again. What is stock investing? When you purchase a share of a company, it is a stock or a piece of that company. One share or one stock is one piece of a publicly traded company. In general, we will be talking about the open market or publicly traded companies. You can own shares of a private company or even a partnership, but that is more of a business discussion. And some companies have ownership programs like stock where you actually own a piece of your employer. But for this video, we will be talking about companies listed on public stock exchanges like the New York Stock Exchange or NASDAQ exchange or any other public exchange. When you purchase a stock, you become a shareholder, even if it is one share. You receive certain rights as a shareholder or owner of a stock. Some of these rights include right to any price appreciation or depreciation, rights to any dividends, and right to vote on any company issues up for a vote. Dividends are simply money given back to shareholders as a thank you for investing. They are usually paid every quarter from the profits of the company. Not all companies pay dividends. Investing or owning shares does not really give you any control over that company as far as the decisions made in the running of that business. Those decisions are carried out by the CEO and other upper management. Owning stock also does not give any rights to collect on any debt owed by the company, and if the company goes out of business, you get nothing. The main risk for shareholders is the price of the stock falling or going to zero, or the company going bankrupt suddenly. Search Enron Company or Silicon Valley Bank or Lehman Brothers. This actually happens all of the time. These are three big examples. Most companies simply do not make a profit or not for long, and they go out of business. This is the way it is. So, as a stock investor, we need to be able to lessen or mitigate the risks involved with owning shares of stock. Three main ways to mitigate risk of owning stocks as a shareholder would be one, diversification or diversify. This is simply a big word for spreading risk over many different stocks in a group or in a fund. This immediately reduces the risk of any one stock affecting your money. Think about, instead of owning one share of one company, maybe you own 100 shares of 100 companies. Then there's dollar cost averaging. This doesn't really reduce risk, but it actually reduces your cost in a way and allows you to buy over a period of time, and we get an average price over that time. So you would simply allocate or dedicate an amount of money or a percentage of your money weekly or monthly to investing. Just think of like if you're involved in a pension or a 401k retirement plan. So most pensions you would have to work 30 or years or more to receive a pension. And in your 401k retirement plan at work, you dedicate a certain amount of money out of each paycheck. That's an example of dollar cost averaging over time. Finally, you can do what's called position sizing and share sizing for traders. And the idea behind this is you can't lose what is not at risk. If you choose to invest in a single company, only allocate an amount you are okay with losing. So that's usually something somewhat small, and that's relative to your account size and your how much money you have to invest. So an example of that would be, if I had a $5,000 account, I wouldn't want to put all 5,000 in one company. Maybe I would only put I don't know, $200 or $500 in one company. Also note, I would not dollar cost average into a losing position on a single stock. So this happens quite a bit too with new traders. They get involved, they buy a single company, and lo and behold, the share price starts going down after they buy it, usually in the short term. So what they do is they wait for the price to start coming back up. It doesn't come back up. And now they start buying more shares at a lower price, which is what you would do in a diversified fund. However, it's a bad idea to do that if your position starts to become more and more of a losing position on a single stock. It's not a good idea. That means there's probably something wrong either with that stock at this time or with that stock in general. So that's kind of not a great idea. It's okay to dollar cost average into a fund where your risk is spread out over many stocks, but it's also okay to dollar cost average into a company you have a reason to dollar cost average into that you believe in and has good fundamentals, and a company you really want to own. That's okay. But if you get into a smaller cap stock, it could be a very bad idea to continue to basically put good money after bad. That's all I'll say about that. Investing for the long term. So when I think of investing, I think of buying a home to live in for the long term and as saving over time. So we all know of someone who bought a home several years, decades ago that on paper has experienced an increase in their home's value. Maybe they bought a house in the 1980s at, let's say, $75,000. At the time, maybe it seemed expensive. Now today it is worth $300,000, which today is average. By buying their home back then, they locked in their cost and the payment on their house, and because of appreciation and location and inflation, the home went up in value. Most people understand that housing is valuable and therefore tends to, but not always, go up in value. Well, the same thing happens with good companies and stocks in general. Over time, the market goes up in value, especially the best companies listed in the S&P 500 index of stocks. The S&P 500 is actually 505 of the biggest, best, and strongest companies in the world and generally dominate their business and their industry. They go up in value because the businesses grow over time in size and in profits, and the share price goes up in value. It's pretty simple. You can participate in that growth by owning a stock fund. Most stock index funds also pay a small dividend to shareholders. There's three main indexes that are the S&P 500 index, as already mentioned, the NASDAQ 100 index, and the Dow Industrials 30 index. The NASDAQ tends to be referred to as the tech-heavy NASDAQ, which has more tech companies. And then the Dow is always referred to as like the old kind of more established companies. Generally, they're industrial companies, not always, but they're more traditional companies. You can buy shares of these indexes through either mutual funds or exchange-traded funds. By buying a fund, you immediately diversify your money investment over many good companies. So why diversify again? The previous example assumes you were invested in a diversified fund for 10 years and received the average return of 10%. Plus, you bought 1,000 shares of Netflix stock and held for the same time. So this slide is out of order. Let's see if I can get that slide to move. 3 types of ownership and diversification. Again, mutual funds, which is just simply a group or basket of stocks purchased through a fund company like Vanguard or Fidelity that sell and manage the funds. You get immediate diversification over a variety of companies. There's hundreds of funds available. And then there's other types of funds that may be more weighted towards a certain group like technology or energy. For example, one may be heavy on Apple, may have 10% of the holdings in Apple. And maybe another fund may be heavy on something like Chase Bank, where they have 10% of the fund in Chase Bank. Again, this is kind of out of your control. You simply just choose the fund that suits your needs and that you are comfortable with. So, again, this is considered safe over time, and you can accept the average return and the average risk of the market. The average market return over time is about 10% long term. Some years are up significantly, like 2024, and some years are down, like 2022 or 2008. But over the long term, markets have gone up on average. Then there is a ETF or exchange-traded fund. Very similar in concept to a mutual fund, only they can be traded and you don't need to buy from a mutual fund company. They can be bought direct through a broker. ETFs generally also offer the same holdings as mutual funds, and again, there are hundreds of choices in ETFs. Vanguard also and other fund companies also offer ETFs. In general, an ETF is a lower cost alternative to a mutual fund, whether it's an index fund or managed fund. A managed fund usually has employees who actively manage the holdings of that fund, and so they need to be paid to work. Lower cost ETF investing has become more popular since they were introduced. Essentially, I can buy the same S&P index fund or a total market fund for a lower price called a management fee or a fund expense. It used to be common to pay between 1 and 3%, and even a closing fee or a surrender fee if you closed your mutual fund as a penalty for leaving your investment. Today, with an ETF, it is very common to pay less than 0.5% or less in ownership costs. I can just go online and buy or sell that ETF fund many times for no charge. You do not need to know what stocks, you do need to know what stocks are inside of the ETF you choose to invest in and what percentage the fund allocates to those stocks. Again, for example, one fund may be weighted toward Apple and another may be weighted toward Pepsi, and this will affect your return on investment. Individual stocks, you can own pieces of a company such as Apple or Walmart and invest in them if you like their business. Maybe you simply like their product or service and would like to take part in their success. This happens again with price appreciation and or dividend payments to investors. Some stocks pay a dividend to investors and some don't. In general, a dividend is like a bonus, and most money made in stocks over time is through price improvement. Most major dividend-paying stocks will be 1 to 5% yield on the high end. Some can pay quite a bit more, but there is the risk to reward factor to consider. High-paying dividend stocks tend to be much riskier. Also, in general, it is considered more risky to own one company versus a basket of companies. So just think of all of your eggs in one basket. What if you drop the basket and go hungry? What if you put all or most of your money in one company as an investment? However, you can safely own individual stocks by simply allocating only a certain amount of your capital to that company, otherwise known as a position size or a percent of your capital. So here's an example. What if you had $100,000 and you assigned $1,000 or 1% to Netflix 10 years ago? It would be worth about $15,000 today. And you'd have a return on investment of 15 times your money, or 1,500% in one holding. You took part in the success of Netflix, and this had a big influence on your account. In 10 years, you would have over $256,000 plus $15,000 in Netflix, or 5.8% of your account in one stock. So the previous example assumes you bought and held a diversified index fund and bought and held $1,000 of Netflix for the 10-year period and received the average market return of 10%. If you like the discussion and are interested in doing some homework, yes, you can succeed in choosing to invest in quality companies. The main reason to do this is to try to get higher returns on your investing, your return on investment. One of the things an investor is always wanting to do is get a higher ROI. Investors put their money out there expecting it to return to them at a higher value or a profit. The faster it returns to them, the better ROI and the better the performance of that investment. Think about it. Would you rather have the house that went from $75,000 to $300,000 or a house that went from $75,000 to $900,000 in the better location? The obvious answer is the latter. A fun exercise is to use an investment compounding calculator and type in the same amount invested and change the ROI percentage over the same period of time. There's a free calculator at investor.gov. One thing that has always puzzled me is why some investors are against individual stocks, especially real estate investors. They can see the potential in a single-family home or a small rental property, but not in an individual public company. One area I think a real estate investor may have an edge in is knowing their local market and timing that market. But market sell-offs in real estate are rare. They think it is too risky, and I am not in control of a stock. If you like this content, we do trade and invest in individual stocks with limited risk, and you are welcome to watch my other videos on technical trading and investing using risk management. For me, it is safer to buy an individual company and limit my risk versus putting thousands of dollars in a single real estate investment. For the same money, I can buy several companies or stocks with very little headache or maintenance. It's simply my preference, and I am not against real estate investment. If you're willing to do some homework and select your stock investments, it has been worthwhile for me, and it may be appropriate for you too. But you don't have to. You could just buy a mutual fund or an index fund and do great and accept the overall market risk and returns over time. So let's talk about results of investing over a longer period, like 30-year period. If we assume we started off with an initial investment of, let's say, $3,750 and contributed $460 per month and had a 10% ROI compounded annually over 30 years, we would have over $973,000 if we stayed the course and did not contribute any more or any less over that period of time. Our total contributions over this period would be just over $169,000. I'm using 10% ROI because over time that is the average market return. If we pay the same payment to the bank over the same period, the bank will receive the $169,350 on our $75,000 house. that is now worth $300,000. I'm using this example because we're just using compound interest in our favor when we invest. I'm not saying don't buy a house. A home is your life and your community, and a great hedge against inflation, and also locks in your housing costs. But it does not compare to the stock market as a wealth creation tool. So you may ask, isn't 5% or 10% enough of a return on my money? Well, it may be for you, but it is not about what is enough. It is about ROI and performance. Again, we would all agree on the house scenario. Now let's use a financial calculator or compound interest calculator and use a $75,000 stock investment as an example. It could be any stock or any fund, but this is just math and how the numbers would work out over 30 years, just like a 30-year house mortgage. Only in this case, we're not paying the bank, we're investing for ourselves. So, according to Freddie Mac, government agency, an average price appreciation is about 4.4% over the long term for housing, according to a web search between 3 to 5%, but some areas are not, so definitely location matters. Using the calculator at investor.gov, I can type in 3750, which is about 5% of a $75,000 house, which would be a fair down payment on a 30-year loan. Only in this case, we'll use that as our initial investment. Also, using a mortgage payment calculator, we can figure out the payment on that loan would be about $460 per month, not including other costs of ownership such as taxes and maintenance. We will use $460 per month as our stock investment capital, or about $106 per week allocated to investing. This is not unattainable. I think that's a fair number to use. So this is just a screenshot of that calculator where I type in our initial investment, how much we can contribute per month, the length and time, the interest rate, and then when you hit calculate, it spits out this graph of how your money would potentially grow. And you can see in 30 years on a just over $160,000 investment, your money will grow through compounding to over $973,000. So that's quite a difference between investing and saving and not investing and saving. So my question to you guys is, why don't more people invest and buy homes? Well, I think the short, easy answer is that we don't think long term in general as people. Everything is day to day and living for now and week to week. I think we can all relate to maybe making a poor relationship decision short term based on feelings of the moment, only to regret that relationship later on. It is always easier to say yes to not making a meal or a coffee at home and paying more for convenience at a restaurant or a coffee shop. Home ownership rates in America have generally been over 60%, currently over 65%, so we can recognize value in owning housing. Stock market participation currently is around 62%, whether through stocks or funds or retirement plans. The bad thing is that in bad times, like back in 2008, people exited the market, only to see it go up again over the next 15 years. I don't know why, but it is an obvious answer to long-term economic security. This next chart shows why people are bad investors. They buy and sell at the wrong time. Another case for diversification, staying the course, and buying and holding the market. Can you see the dip in 2008 after the financial crisis? I understand there are people that can't or choose not to earn income, and that some have it harder than others, but I don't think that should persuade you not to invest. And I think you should be an example and maybe help them out. I understand sometimes the economy is better than other times and for some groups. It's never easy to save and invest now, just as it is really never the right time to buy a home. It takes some discipline and budgeting sacrifice to allocate money to investing. But you can do it and are welcome to join if you choose. Just start today with what you have and where you are at. Yes, even $10 a week will make a difference later on. So this chart simply shows the percentage of stock ownership over time as a percentage of the population. You can see over here 60%, and then it kind of goes up and starts going down around 2006, just starts this trend down into 2008, 2010, and continues down into 2012 and even 2013, getting near 50%. So about 10% of the population exited the stock market after this financial crisis in 2008. And it was already kind of in a downtrend anyway. I'm not sure why that trend started back there, but it did. And then after that, all of a sudden stock market participation started to creep up again, especially after 2016. So by selling back here, a lot of investors missed the appreciation on the other side of that curve. And that's really tough to time the market. And I think some people were trying to. Now let's focus on, why do we focus on depreciating assets and looking good? Again, I think the short answer is it feels good in the short term. And usually people will compliment us on our purchase or our appearance. Look at how successful we are. We have a nice house, a nice area. I drive a new car. I have new furniture. My wife wears nice clothes with nice new shiny jewelry, and so do my friends and neighbors. But as in all things economic, there is a downside to that. It's called lost opportunity. Let's see what I mean. Investors are generally maligned as being cheap, and sometimes that is fair. However, the real reason investors seem cheap is they simply do not value things that go down in value. They know that their money is working for them and not against them, and they do not care what you think. Again, timing the market. It really is not a great time to enter the market. Only in hindsight do we see the evidence of that, just as the case with home ownership. Now, 2008 and the COVID crash seem like great buying opportunities. At the time, it was pretty scary and there was a lot of fear. Let's look at some returns over the last 1, 3, and 5 years using the S&P 500 ETF, symbol SPY, referred to as the SPY, which tracks this index very closely. It is highly correlated in performance. This is using a closing price on Friday, December 13th of 604.21, which was at all-time highs. And at that point, there was a 1-year return of over 28%, 3-year return of over 31%. Remember, 2022 was a down year, or a bear market, and a 5-year return of over 88%. So, were you invested over the last 5 years, or were you just looking good, or both? Why we should focus on assets or items that go up in value or appreciate. Again, the average market appreciation rate using the S&P 500 is about 10.5%. Average annual inflation rate is about 3% over the long term, which is your money losing value. Some years are lower and some years are higher. Oftentimes, inflation is looked at as goods and services costing more, but the other way to look at it is your money losing value. The average credit card rate is over 21%. Yours may vary, but this is simply buying stuff you can't afford. Auto loan rates vary by buyer and credit, but 5% to 19% is pretty normal. Yes, you may get 0.9 or 1.9, but this is buying items going down in value because the average depreciation rate for cars brand new off the lot is about 20% the first year and about 15% a year after that. The national average home appreciation rate varies by area, again, somewhere between 2 to 6%. which is a traditional hedge against inflation. Again, a great investment. This is buy and hold. Homes require maintenance, taxes, and insurance. The long-term national average mortgage interest rates is about 6%. Yours may be higher or lower, but that's the average. Clothes depreciate at 20 to 50%. Electronics are even faster at 30 to 70%. Jewelry in general depreciates at 30%, and furniture at about 10%. Interestingly, farmland has an average appreciation rate of 5.5%, plus a farm as a business, creating income from crops or livestock. In conclusion, if you focus on buying items with credit that go down in value, you're putting yourself in a vulnerable financial position of weakness. If you buy and invest in assets that tend to go up in value, you set yourself up for a better financial future. Would you rather have some financial security someday or work until you can't and still be in a poor position? I think the choice is yours. If you are thinking, no way am I buying now at all-time market high prices, you would be wrong. And why? Well, because the stock market is not like shopping and looking for bargains at cheaper prices. Actually, the way it works is the market tends to make newer highs over time. So today's high will be the new low maybe several years from now. Usually stocks making new highs tend to keep making new highs, and bad investments making new lows tend to make new lows over time and or go out of business. When you buy a basket of stocks, you again get diversification of the good and the bad companies. Over time, the good ones outperform and the bad ones are removed from the market. A kind of natural performance sorting process that is automatic for you inside of an index fund or a mutual fund or an ETF. The best time to invest is simply now. Again, if you are so smart, including myself, and good at timing the market, did you buy in 2008 or 2009? How about in 2022 into 2023 when the market made a quick turnaround? What about the bottom in 2020? How about the pullback in 2015 to 2016? If you did not take advantage of these buying opportunities, then you probably won't see the next one. You just need to start investing today for your future. And here is a monthly chart over a 5-year period of the S&P 500 ETF SPY. And it's pretty easy to read, going from left to right. You can simply see that price over that time has appreciated. Yes, there was a couple pullbacks during this period, mainly right here in 2020, and again here in 2022. And then since then, it's been, pretty much up over that time. Now, if you look at a shorter term chart, you'll see more volatility. But this is a monthly chart over that time showing appreciation over that period. How to build confidence. Keep reading and learning all you can about the subject and take some action and buy your first investment. The most painless way to do it is to participate in a retirement plan at work and invest in a diversified fund or ETF. There's also several good books to read that help me out, such as Common Sense on Mutual Funds, How to Make Money in Stocks, The Snowball Effect, Stocks for the Long Run, and One Up on Wall Street. I'm going to show you guys one final chart. Thanks for watching, liking, subscribing, and sharing. You can find me at Laptop Trader on YouTube. The S&P 500 index since 1980, and my final piece of evidence why everyone should consider being an investor in stocks. Again, good luck. This is Philip the Laptop Trader. Here's that final chart showing since 1980 the appreciation in the SPX index. So if you didn't take part in that, you simply missed out, and you just have to start where you are. Thanks again for watching, sharing, liking, and subscribing. We'll end this video here, and I hope to see you guys in the next video. Goodbye.